A new label for a risk grouping is emerging in Europe's bond market. PIGS was a common term during the euro debt crisis of 2010 to 2011, a reference to countries badly affected: Portugal, Ireland, Italy, Greece and Spain. Well, investors say attention is now shifting to BIFFs. Britain, Italy and France have been grouped together under the new term after borrowing costs climbed sharply across all three economies. Since the Middle East conflict began, yields on the country's 10-year bonds have risen by or around half a percentage point. Let's talk to the distinguished international economist, Vicky Pryce. Vicky, welcome back. Good to see you. So what has changed structurally to shift investor concern towards Britain, Italy and France today? Is this just about the Middle East?
To a considerable extent it is. I think there's been a worry about the extent to which countries like the UK had enough fiscal room to support consumers and also businesses during this crisis. And the expectation has been that because of that limitation in those fiscal rules that have been imposed, if you like, both by the UK but also in the Eurozone, there would be perhaps not an awful lot that can be done to support those countries, and if the population and businesses, but if they were to intervene much more heavily, which is one of the things that quite a lot of politicians have been asking for, then if you add to that the concerns that everybody has had about the extent to which one would need to increase defence spending, then that puts some pressure on the debt to GDP ratios that these countries have, and they would need to go out and borrow quite significantly. Of course, when you look at Europe in particular, they are all getting together in a way in order to raise funds for defence, and it's entirely possible that the UK is going to be part of this. But it's generally believed that it is those countries that are going to increase and are going to bear the bulk, if you like, of the extra defence spending. And if you add to that the pressures that are now coming because of the situation in the Middle East, then that is going to hinder, if you like, what capital markets think in terms of being necessarily prepared to lend to those countries at any rates which would have been acceptable. So what you've got now is that in many of those, the debt to GDP ratio looks like it will be going up, and the interest rates and therefore the cost of servicing the debt will also be going up. I think that's what the markets are suggesting right now. And you're quite right to put that distinction between those countries and countries which perhaps are not going to have to quite bear that cost, like the southern European countries, which have been favoured recently by investors, sort of up to a point, of course, because we do not know what the impact overall of the crisis that we're seeing at present will be. Some improvements seem to be happening. And yields are going down as we speak, because I've just, as you've been asking me this question, I've been looking at the movements, and they're all going down. So there could be indeed a reevaluation of the whole thing in the next few days. So let's see. But for the moment, your analysis is correct.
Hey, that's breaking news. It changes while you're speaking. Let me ask you about the 2010s. Austerity, we remember, and structural reforms helped the PIGS countries recover. I wonder if similar measures would work for the BIFFs today.
Well, if you heard what the IMF has been trying to say, it's saying that what all these countries should be doing is really limit any sort of support and subsidies that they give to consumers and businesses, and that they should be very watchful of their debt situation. But of course, the bigger countries in Europe can still issue a reasonable amount of debt. There is quite a lot of confidence in them more generally. And the fact that they are all, to a considerable extent, sort of getting together, particularly the European ones, and the UK is getting closer, particularly on the defence side, suggests that perhaps we are talking about maybe some reinforcing mechanisms between them. And what, of course, Europe in particular is trying to do, and you're right to be thinking about what happened in 2010, where, of course, a lot of the smaller countries were very badly hit and needed to get bailed out. What I think we're seeing now is that there is a lot more preparedness to have sort of joint issuing of debt, so Eurobonds, everyone's talking about that, raising funds for defence together. And I think that is, in many ways, quite reassuring for investors, because, of course, if you do it in a bigger scale and you've got countries like Germany more or less guaranteeing that type of of debt, then you may be able to borrow more cheaply. So there is an issue of confidence in this, and if the markets start believing that indeed we're going to be talking about a European market with a big capital ability and of course also supporting industries in particular sectors and not just in defence, then they might be much more prepared to invest in that country in all sorts of ways, bonds and of course equities.
Vicky, good to see you. Thanks for that. Vicky Pryce, the international economist.